Fibonacci gets a bad reputation from two groups. The first group draws random levels on every chart and finds significance in every touch. The second group dismisses it entirely because there is no rational reason a sequence derived from rabbit reproduction in medieval Italy should have any bearing on stock prices. Both groups are missing the point. Fibonacci levels work because enough traders and algorithms use them that they become self-fulfilling at key price points. The 61.8% retracement is watched by quantitative models, professional traders, and retail participants simultaneously. When price approaches that level during a healthy pullback, the concentration of limit buy orders creates a real support effect. That is the mechanism, not mysticism, coordination. AI helps you apply it precisely instead of arbitrarily. Two applications matter: retracements and extensions. Fibonacci retracements measure how far a move has corrected. You take the starting point of a move and the ending point, and the levels 23.6, 38.2, 50, 61.8, and 78.6% show where pullbacks are most likely to find support before the original trend resumes. The 38.2 and 61.8 are the most widely watched. The 50% level is not technically a Fibonacci number, but it is included because major pullbacks frequently find support at exactly the midpoint. Fibonacci extensions measure how far a move may continue beyond its previous high. After a retracement holds and the original trend resumes, extensions project the likely targets: 127.2, 161.8, and 261.8% of the original move. These become your price targets for the continuation trade. The key discipline: Fibonacci levels are only meaningful when drawn from significant swing highs and swing lows, the most recent major turning points, not arbitrary local highs and lows. Garbage in, garbage out. AI helps you identify the right anchor points. Prompt 1 identifies where a current pullback is most likely to find support. Use this prompt. Using the price data provided, identify the most significant swing low and swing high in the past 6 months that define the most recent major uptrend. Calculate the Fibonacci retracement levels from that swing low to that swing high: 23.6%, 38.2%, 50%, 61.8%, and 78.6%. State the exact price for each level. Then assess the current situation. Is price currently in a retracement? If so, which Fibonacci level is it nearest to? Have any of these levels already been tested? If tested, did price hold and continue, or did it break through? Finally, identify which of the 5 levels has the most additional technical confluence, nearest to a moving average, horizontal support, or prior swing level. The level with the most confluence is the most likely support. A 61.8% retracement that also coincides with the 50-day moving average and a prior resistance level that flipped to support is 3 things saying the same thing at one price. That is where the buyers should be most concentrated. 3 things to extract from the retracement analysis. Retracement depth. A healthy pullback should not exceed 61.8% of the prior move. If price has already corrected past 61.8 without finding support, the trend is often weakening rather than resting. Shallow retracements, 23.6 to 38.2, indicate extremely strong trends where buyers refuse to let price fall far. The tested versus untested level. If price has already broken through 38.2 but has not yet reached 61.8, the 61.8 becomes the next significant level. That is where you want a limit order ready, not a market order when price hits it, but a pre-planned entry at the confluence zone. Confluence scoring. Ask AI to explicitly score each retracement level by how many other technical factors align there. 2 additional factors is interesting. 3 or more is a high conviction level. 1 or 0 is weak and may not hold. Prompt 2 uses Fibonacci extensions to establish price targets once a retracement has held. Once price holds at a retracement level and begins resuming the original trend, extensions give you mathematically derived targets for the continuation move. These are not guarantees. They are the levels where resistance is most likely to emerge based on the structure of the prior move. Use this prompt. The stock completed a retracement and has resumed its uptrend. Using the swing low and swing high from the prior move, calculate the Fibonacci extension levels 100%, 127.2%, 161.8%, and 261.8% extension from the retracement low. State the exact price target for each extension level. Then assess how each extension level relates to other technical resistance, prior swing highs, round numbers, or key moving averages. Identify the most significant extension level based on additional confluence and explain why. Extension levels give you a position management framework instead of guessing when to exit. The 127.2 is typically the first meaningful resistance level after a retracement. Take a partial profit here and let the rest run toward 161.8. The 161.8 is the level most often associated with completing a move. When price reaches it, that is where the statistical weight of historical behavior suggests being cautious. Not always. Strong trends push through, but it is where your largest parcel exit should be. The 261.8 is the blow-off target, reached only in genuinely powerful trends. Without a concrete example, that number sounds abstract. So here is what it actually looks like. A stock moves from $3 to $5. That is a $2 swing. Price pulls back to $4, a 50% retracement that holds. The trend resumes. Here is exactly where each extension lands from the $4 retracement low, using that $2 original move, 127.2%, $4 plus 1.272 times. $2 equals $6.54. First resistance, partial profit, 161.8%. $4 plus 1.618 times $2 equals $7.24. Main target, largest exit, 261.8%. $4 plus 2.618 times $2 equals $9.24. Blow off level, only if the trend is exceptional. That is what 261.8 means in practice, not a mystical number. A price that sits 2.5 times the original move above the retracement low. When a stock reaches that level, it means buyers absorbed every piece of supply on the way up. Exceptional, but identifiable in advance. The bonus move creates a complete map of all Fibonacci levels across multiple swing moves simultaneously. Any single retracement or extension is one data point. When you draw Fibonacci from multiple significant swing moves at the same time, the levels that appear in multiple grids at approximately the same price become the highest conviction zones on the chart. Use this prompt. Identify the 3 most significant swing moves in this stock over the past 18 months. For each move, calculate the retracement levels, 38.2, 50, and 61.8%. Then identify any price zone where 2 or more retracement levels from different swing moves fall within 1 to 2% of each other. These are confluence zones. List every confluence zone you find. State the price range and identify how many separate Fibonacci grids are contributing to each zone. Rank these zones by the number of contributing levels. The zone with the most levels clustering together is the highest conviction support or resistance zone on the chart. A price zone where 5 separate Fibonacci calculations converge is not a coincidence. It is the level that the most market participants are watching simultaneously. That is where the most significant reactions occur. Fibonacci works because the market believes it works. The mechanism is not mystical, it is coordination. When enough participants use the same levels, those levels become real. Prompt 1. Retracement Analysis. Identify where a current pullback is most likely to find support. Look for the level with the most additional technical confluence. Moving averages, prior support, round numbers all confirming the same price. Prompt 2. Extension targets after a retracement holds. Project the continuation targets to build a systematic profit-taking framework. Partial at 127.2, largest exit at 161.8, and know that 261.8 is in play if the trend is genuinely exceptional. Bonus: Confluence Mapping. Overlay Fibonacci from multiple swing moves and find the price zones where the market's attention is most concentrated. Those are the levels with the most evidence behind them, and where the most significant reactions will occur. Used properly, Fibonacci is not a magic wand. It is a coordination tool, a way of identifying where the most participants are watching simultaneously, which is exactly where the most significant reactions will occur. Next episode, VWAP and Volume Profile, the tools institutions use to track their own execution and what they reveal to anyone paying attention. See you Thursday.